this video, I'm going to be teaching you how C Corp taxes work. Usually it's reserved for your larger businesses, but some small business owners elect to have their business taxed as a C Corporation. And I want you to understand how the taxes work when you're a C Corporation, not just how much you have to pay in taxes, but how the tax forms are actually completed. So I'm going to, in this video, walk you through how much taxes you might owe if you earned roughly $100,000 of profit and you ran your business as a C Corporation, as well as the tax forms, the Form 1120, which is what you would have to prepare by April 15th, and show you that a C Corp return is not a pass-through entity. The C Corp itself has to pay income tax. And then when you, as the shareholder of that C Corporation, take money out of the C Corporation in the form of dividends, you then have to pay tax again. That's called double taxation, and we'll talk through that. By the way, if you're watching this video is a series, or I should say this video is part of a series where I'm talking how taxes work for sole proprietorships, S corporations, partnerships, and even C corporations. So if you want to learn how sole proprietorship taxes work, or the S Corp or the partnership taxes work, find this video series. There's probably a link in the description below, and you can learn more about those other entity types. So don't think I'm just talking about the C Corp only. So what I'd like to do, let me take you through this document I've got here. I'll go through this rather quickly, and then I'll show you the actual tax forms, okay? So in my scenario here, we've got a C Corporation, which has business revenue of $125,000. That means you sold $125,000 worth of product, or perhaps performed $125,000 worth of services. You had $28,060 in business expenses. You'll see why I chose that somewhat odd amount in a moment, which left you with $96,940 in business profit. Now, your C Corporation made a profit of $96,940. If you, as the shareholder of that C Corporation, are performing services in order for that C Corp to earn this profit, or I should say you materially participate, that might be the technical term for it, then you've got to pay yourself a reasonable compensation based on the services that you're providing. In this example, I'm just choosing $40,000. So let's say your name is John. You've got to pay yourself $40,000 in reasonable comp, which means you have to pay Social Security and Medicare taxes. You might hear that referred to as FICA taxes on this $40,000. Now you, John, have to pay your share as the employee of Social Security and Medicare. That's 7.65%. 6.2 for Social Security, 1.45 for Medicare. So 40,000 times 7.65% is 3,060. The C Corporation has to pay FICA taxes as well, Social Security and Medicare taxes as well, in the same amount, okay? So on the 40 grand, it's $3,060. You can see that breakdown here, okay? Total $6,120. Now, I don't want to get into the other entity types, but real quick, this is much better than the $14,129 you'd be paying in Social Security and Medicare type of taxes over here at the sole prop. $6,120 saves you roughly 8 grand in Social Security and Medicare taxes, okay? Now, what about the other $56,940, right? Your business profit was $96,940. You took $40,000 as reasonable compensation. Now you have this $56,940. What are you going to do with it? Well, what you have to do is your C Corporation has to pay income tax on the $56,940. I'm going to show you this on the tax form in just a second. Okay, so $56,940 times the 21% tax rate is $11,957. The C Corporation itself is paying that as an income tax. Okay, that's different from all these entities here that are pass-through entities and don't have to pay tax, or I should say don't have to pay income tax at the entity level. Now, if you, the shareholder, take this profit out of the C Corporation, you're going to take that out as dividends, okay? And so what's going to happen here, the other taxes you have to pay is, let me cover this one first. You have to pay dividends, capital gains taxes on $56,940, and that's going to equate to $5,770. Now, the federal capital gains tax rates are between 0%, 15%, and 20%. In this situation, the amount of income that this person earned Some of their capital gains is being subjected to the 0% tax rate, so they don't pay any capital gains tax. And some of the money is being paid at 15% tax rate. That's why you can't easily calculate 56,940 times 15% doesn't equal this. It's because it's a blended rate between some at 0 and some at 15%. What's this 2009-21? I'm going to show you this on Form 1040 on the individual tax return in a second, but it is the income tax, not capital gains, but ordinary income tax that you are paying on this $40,000 of reasonable compensation that is paid to you. But if you add all this tax together, the C Corp tax, the Social Security and Medicare taxes, the income tax and the capital gains tax, it's a total tax of $26,768. So if you only made $96,940, and to get all that money out of your business, you had to pay $26,768 in taxes. That's a tax rate of 27.61%. We call that an effective tax rate. Okay, it's your sort of taxable income. It's your total taxes divided by your taxable income. Other people define that a little bit differently. That's how I'm defining it, because that's the profit you made, and that's the total amount of taxes that you have to pay. Okay, compare that to these other entity types. A partner in a partnership earning 100 grand, so earning more than 96,940, earning 100 is paying 23.36, and S corporation is paying 17.75 on the same amount of profit. Sole proprietor is paying 23,357 on $100,000 worth of profit. Okay, there is a place for the C Corp. It's just not, in my opinion, for these smaller operational businesses. If your business profit, there's no hard and fast rule. It's a case-by-case scenario. But unless you're going to be utilizing or leveraging some of these tax-free fringe benefits, such as a HRA, that's a health reimbursement arrangement, and some of the other tax-free benefits, I don't really think it's worth going this route. But there's a place for it. Okay, let's go through the C Corporation tax return. Again, it's called Form 1120. The due date on this Form 1120 is April 15th, the same due date as your individual tax return. You can file an extension, and the extension will give you another 6 months to file the return, and that will be due on October 15th. I'm not going to go through all this stuff on the top here. It's basically just a made-up company name with a made-up address with a made-up EIN number. The date it was started was January 1st, 2023. This is a 2023 tax return we're going through. And so here's that $125,000 of revenue, right? You sold this much product or offered this much of service, and your clients paid you $125,000. That's your income. Then we have your expenses. The $40,000 of reasonable compensation that you have to pay yourself, that's an expense to the C Corporation. Then you have the $3,060 in taxes. What is this? This is the employer portion of Social Security and Medicare on the $40,000, right? 7.65% times 40 grand is going to equate to this number. Then you have some other expenses here. Now, I'm trying to simplify this, and I just put $25,000 under advertising here. But in the real world, this might be divvied up between rent payments or office expense or things like that, right? Actually, let me just take a quick moment to introduce myself. I'm not sure I've done that yet. My name is Navi Maraj. I'm a CPA who teaches entrepreneurs just like you how to save thousands of dollars in taxes. I'm kind of doing that now in this video by showing you and comparing these various entity types so that you can make a smart decision and have your business tax in a way that's very efficient. But not only do I do that for free right here on social media, I also do it through a course. The course details are on my website at navimarajcpa.com, and you can also find the link in the description below, depending on what platform you're watching this video on. But in the course, what that course is designed to do is convert you from a entrepreneur who's just starting out, who may not know anything about accounting, how taxes work, the various tax strategies, QuickBooks, all of these various things. I teach you how to implement those strategies on your very own. And I walk you through it step by step in a very easy to understand way. And we convert you into a tax savvy entrepreneur. And it'll allow you to save thousands of dollars in taxes each and every year. Why I bring that up at this point in time is because this tax return would be flooded with tax deductions and strategies had we been working together either through the course or in person if you're one of my clients that I work with on a one-on-one basis. Okay, now we had $25,000 in expenses, which I said was advertising. So our total expenses or our total deductions is the 40 grand here of reasonable comp, the 3,060, which we said was the employer portion of Social Security and Medicare, and the $25,000 in advertising expenses for a total of 68,060. So if I subtract 68,060 from the 125, I get 56,940. This is the taxable income that the C corporation earned and has to pay tax at a rate of 21%. So 56,940 times the 21% is 11,957. If I were to show you, or if you go view the other videos in this series and you look at the partnership tax return and the S corporation tax return and the Schedule C for the sole proprietorship, there's no amount owed or tax due at the entity level, at the business level. Okay, but with the C Corp, it's not a pass-through entity. The C Corp itself, in this example, sample business C Corp, has to pay $11,957 in taxes. Going back to my spreadsheet here, this is the $11,957 that I'm talking about, okay? So that's the C Corp tax return. It's actually quite straightforward, one of the easier tax returns to prepare. It can get complex, but it's pretty straightforward, especially when you compare it to like a partnership tax return. Now, what about your individual tax return? You're the shareholder of this C corporation. It's your business. You own it 100%. What does your individual tax return look like? Well, here we have Form 1040 for the year 2023. Let's just say your name is Sample Individual. If we scroll down here, we see that on the front page, there's a W-2 amount here. Remember that reasonable compensation of 40 grand? Well, you're claiming it here on your individual tax return. That's what the 40,000 is. Then the dividends that you're electing to take out of the business, they're qualified dividends. I'm giving you the advantage and saying these are long-term capital gains taxes. Technically, if you pull this money out within the year that you earn it, there's an argument that could be made that this was less than a year, so you have to pay ordinary income tax rates. So I'm going to say that they're long-term capital gains tax rates and give you the benefit of the doubt, okay? So you took out that dividend, $56,940. So your total income was $96,940. From here, you get to take the standard deduction. The standard deduction is $13,850. If you itemize your deductions and your itemized deductions are greater than $13,850, then you'll take that larger dollar amount. I don't want to get off on a tangent here, but itemized deductions might be the total of your out-of-pocket medical expenses, real estate property taxes, mortgage interest, charitable contributions, a couple other items. If those dollar amounts are greater than the $13,850, then you'll itemize your deductions and take that larger amount. I oversimplified the itemized deductions. There's details with all of those things I just mentioned. So this brings our taxable income, $96,940 minus $13,850 to $83,090. Now, what tax do we have to pay? We're paying $8,691 in tax. That's not an easy calculation to do on your own though. Why do I say that? It comes back to this. If you add these two numbers, that's how you get the sum of the $8,691. But some of it is income tax, some of it is not taxed at all, the dividend, and some of that dividend income is taxed at 15%. I'm being very generous with this example, and you still end up paying more money in taxes than here with the other entity types. When I say very generous, I'm saying, we're treating those dividends as qualified dividends, so long-term capital gains, not ordinary income tax rates. And someone out there is going to say, well, Navi, what if I didn't take this $56,940 in the form of a distribution, and all I did was I kept that money in the business? How much tax would I pay? Well, you'd pay $20,998 with an effective tax rate of 21.66%, which is still higher than the S corporation, right? So I'm not sure the case could be made to leave that in there. Again, there's a place for the C corporation. It's just not here in this particular example. So if your business is making, I don't know, 150 grand or less in profit, chances are C corporation is not right for you. But I hope this was helpful in helping you understand how C corporation taxes work. As a recap, you got to file Form 1120. It's due April 15th. You can file an extension and have it due October 15th. It's not a pass-through entity, so the C corporation itself pays income tax, then that money that you were paid as reasonable compensation flows through to your individual tax return. And if you took that money out of the C corporation, that means you took it out in the form of a dividend, and that dividend money that you took out is subject to capital gains tax rates. If you've held that money for greater than a year, it'll be long-term capital gains tax rates. I know it's a little bit confusing. I'm showing you here on NerdWallet's website those various tax brackets. If you're single and you make less than this amount in capital gains tax rates, 0% is what you'd pay. But there was a blended amount for our scenario situation there, where we had some of it at 0, some of it at 15%. Like I said, in our situation, a little bit tricky there to try to recalculate that on your own. But I hope you found this video helpful. If you did, please give it a like and maybe subscribe to the channel. And as I said, this is one video in a series of videos. Go check out those other ones where we talk about the sole prop, the S corporation, and the partnership, so you'll understand just how these taxes work no matter how your business is taxed. I'll see you either in the next video or in the course.